Welcome back to Switzer. After weeks of a falling market, have the number of local companies where the share price is less than the intrinsic value of those companies actually increased? Roger Montgomery, Chief Investment Officer at Montgomery Investment Management, is the one man who can put his finger on those companies. So let's twist his arm to make sure he does. How are you, mate?
I'm glad you said twist my arm and not break my finger.
That's right. You need a finger on the calculator.
Yeah, correct.
You could do with a broken arm, I guess. Now,
could.
You've been away, and
Yes.
we've missed you shockingly.
We've both been away. You've been away too.
That's true. That's true.
You've got a tan.
Yeah, well, Greece and
It'll do that to
Turkey
you.
will do that to you as well.
Very good.
All right, now, China.
Yes.
It's been an issue that you never used to talk about. Then about 6 months ago, you started talking about China. Now, whether Jimmy Chanos influenced you, you did, but
it was about a year ago.
You got more serious about China. Okay.
We've been, as you know, we had mining services companies, and we got out of them in April 2012.
Yeah.
So it's been about 18 months that we've been worried about China.
Right.
And we're looking at it closely all the time, and it's not getting any better. And there's a couple of things to look at. They reported Charlene Chu from Fitch downgraded, you might remember back at the end of June, she downgraded China's credit rating to AA-. And one of the observations that she made, which was less reported, was that the pace of credit growth in China since 2008 to 2012, so those 4 years, had grown at double the rate of GDP. Right? So it's grown about 73%. And double the rate of economic growth. Now, that is completely unsustainable. Whenever it's ever happened elsewhere in the world, it's led to a major credit problem, a major financial crisis.
Yep.
And she described it as the most reliable predictor of a financial crisis. Yeah. Now, let's say that's not going to happen.
By the way, that's what Steve Keen was saying before the GFC. And Rubini was saying the same thing as well.
Well, you can always pick people who talk about this stuff, but it's important to get your timing right.
Yeah.
You know, and that's the important part. And so I think leave that aside for a minute. That's just one view, and let's look at a company. There's a company called Rongsheng. Rongsheng is the biggest privately owned, bad name.
Hey, Rongsheng, isn't
Rongsheng.
it? Yeah, wrong name.
It's the biggest privately owned shipbuilder in China. No. Biggest non-state owned one.
Right. Okay.
Laid off 3,000 workers. 3,000 workers just said, go home. Yeah. Don't come back in. We're not paying you. Debt of $3.2 billion, cash of about $600 million, and significantly falling orders. Significantly falling orders. Now, this is just the tip of the iceberg. We've talked about other companies before. I talked about the company that manufactures the equipment that they use to make roads. Falling orders, going broke, problems all over China. This means, and you've got to remember, between 2001 and 2011, China accounted for all of the growth in iron ore, coal and oil. And they are not
all
only
of the growth. Yeah.
They are not only coming off not bad for a country,
the demand, but the growth of demand.
The growth in demand.
Okay, good, yep.
Not bad for a country that represents about 11.5% of GDP globally. But they are now in a position where not only is it softening, but the softening is accelerating. It's getting worse faster, and you see analysts talking about 7% growth for China. You know, they're the same analysts that were saying 9% last year, and it's now 7%. And I think we'll see...
7.7 was the last official figure we got.
It doesn't really matter. We're talking about 5% or 4%. We're not talking about 7%.
Yeah.
It's going to get a lot worse. And given all of the growth, you've got to remember, prior to the boom in resources that we had in Australia, resource companies made up about 10% of the small ordinaries index. And at the peak, they made up 45%. Now, they've halved. Right? So the small resources index is off 50% from its highs. And everyone's sort of rubbing their hands together and saying, well, there could be good value here. And we saw today the materials rally.
Provided the companies go broke, there could be some value there.
Yeah, correct, that's right. Now, what I'm saying is that we could see, if it goes back, if the weighting of the resources in the small ordinaries goes back to what it was prior to the boom, that 10%, it could halve again. So there's no value there if companies are on the verge of going broke.
So kill small resources companies, kill mining services companies.
There's no need. The story is just unfolding. It's not over yet.
Yep.
You know, the thing that people never learn in the stock market, and I see this, and I think it's because what happens is the old heads go very quiet, you know, and we don't talk usually that much about what's going on, although we like talking about it, but most people don't. But the new guys coming in, they've not seen the last cycle, you know, and so for them, what's the next thing? What's the next thing to buy? What's the next story to get excited about? And I'm here to tell you that I don't think there's anything to get excited about for us.
The important thing that will determine whether you're right or wrong will be, does China not end up in the 6% band but goes to 5 or 4? And that's what you're worried about?
No, I'm more concerned about something that is actually happening in Australia, and that is the unwinding of the investment construction boom in the resource sector. It's going to drop, it's forecast to drop by 75%. 75%, 3/4 is gone. And the impact on that is not only on Aussie equities in that space, but it's also on economic growth, and we're seeing unemployment tick up, and it's going to go higher. We're going to see, we'll see Western Australia in a recession, we'll see the Northern Territory in a recession, we'll probably see Queensland in a recession as well, because the coal industry is slowing down. And what does that mean for enthusiasm for the consumer sector? Zero, because people are going to pull their heads in. They're going to go to barbecues and they say, well, that guy and that guy have all lost their jobs. I'm not going to spend any money. I'm not going to buy a house. I'm not going to buy a car at the moment. And we'll talk ourselves into a very significant slowing down in Australia.
So the dollar falling is not going to be a help?
Well, eventually it will be, Peter. Eventually it will. But you and I, if we were running a business, we're not going to invest in manufacturing, for example. We're not going to invest millions of dollars in plant machinery unless we think the Aussie dollar is going to stay low. If we think it's just going to drop and then bounce again, well, we're not going to do that. We need to see it stay down for a while.
But the current view is that it will go into the 80s.
Well, I hope that's right. I'm
and Credit Suisse
short the Aussie dollar.
Yeah, Credit Suisse tipped 75 by end of 2014.
Look, these are the same people that probably said it was going to $1.20.
But another interesting statistic, a chart I saw was from CBA, and they showed that for commodity prices to stay around where they have been, China only needs to grow around 6%. Like, you know, we're thinking 8 and 7, so 6. But so that's why I wanted to come back to your 5 and 4.
That's fine. That's fine for the companies that are actually producing. And producing
BHP and Rio
and producing and selling above cost.
BHP and Rio.
But for everybody else,
yes, that's right.
You know, everyone's losing jobs.
Okay.
And you've got to remember, BHP has not added any economic value to its business since about 2007.
Tried. Canada stopped them.
Its profit is still, last year its profit was 15 billion. In 2007 it was 15 billion. But they've now got $30 billion more equity in on their balance sheet, and they're not earning any more profit. Now, if someone gave us $30 billion, we could stick it in the bank and we could earn a lot more money with $30 billion. This is a company that has taken an extra $30 billion and done nothing with it. That doesn't add economic value. So the intrinsic value of the company is not going up. In fact, there's a very real risk it could go down a lot.
Okay. Leave that now. You've made that one. Your 3 A's. Three companies that David brought up when you were away.
David Buckland talked about Amcom, he talked about Ainsworth, and he talked about ANZ.
Yeah, we got 1 minute left, mate.
ANZ and Amcom have both gone ballistic, obviously, since then, and Ainsworth hasn't. But Ainsworth is the one we like the story very much.
Yes.
And so we think there's still an opportunity there.
So don't give up on Roger's 3 A's.
The Montgomery 3 A's.
Montgomery 3 A's.
That's right.
Not Roger, Montgomery. And also, it's going to be critical. If China can't get out of this 4 or 5% trap that you're talking about, well, then you may well be right. If they do, you'd be wrong.
Well, the Aussie economy is slowing down anyway.
Yep. Okay, mate. Hope you're wrong on the recession front. I hope you get slowed down.
I hope I'm wrong too.
Yeah, well, I hope you slow down, but we will test that out as the weeks go by.
As always.
Roger, thanks for joining us on the program.